or I will do business with Chevron instead of Exxon. And so generally, if you want to get treated fairly, any business school would say to you, okay, you create a competitive auction and you find the 2 or 3 specialists, when you're the restaurant and you want to lever Coca-Cola for a better deal on Coke and Diet Coke, you don't threaten to create your own, beverage company or do it yourself and create Mikey Cola. What you do is you bring in you have the Pepsi sales guy and you have the Pepsi hat sitting on the table. You say, I just met with the dude from Pepsi and he offered me a better deal. And the Coke sales guy goes back to the district manager and says, Pepsi's in there talking to them, so I think we better give them a better deal.
Scary Assets, a bi-weekly podcast presented by Onram that explores the growing role of Bitcoin in modern finance strategies. Hosted by certified financial planner Andy Edstrom and former hedge fund manager Jesse Myers, we dive deeper into the insights you need to stay ahead of the curve. From wealth managers to financial professionals, Scary Assets equips you with the knowledge to outperform your peers in the decades ahead. Join us every other week as we unpack the latest trends and strategic approaches that will fuel the future of finance. Bitcoin, a swarm of cyber hornets tirelessly defending the goddess of wisdom. They feed on the fire of truth, growing ever smarter, faster, and stronger exponentially. So protected behind an impenetrable wall of encrypted energy, Bitcoin evolves with every block, shaping the future with unrelenting precision.
And of course, there's only Coke and Pepsi. That's only 2. As a practical matter, you have to have 2. When there's 1, you're in deep trouble. But Satoshi gave us 10,000, right? 10,000. There's 50,000 banks, right? If you get like 100 custodians competing with each other, you're going to have a pretty good market and a pretty fair market. And I think that's what's going on here. So the big institutional holders like MicroStrategy or the big ETFs, they're going to use regulated custodians. They're going to put pressure on them. By the way, there's the crypto anarchist and there's the libertarian view: not your keys, not your coin, and it's an important mantra. But barking at Coinbase and telling them, or barking, at Mt. Gox, or, yelling at some exchange to be better on Twitter doesn't work, right? I'll tell you what works. When BlackRock has $20 billion of assets, and then the guy that runs the BlackRock ETF goes to talk with Coinbase, or when Fidelity looks and they're like, well, I think we'll just go and do it ourselves. When a megacorp with trillions of dollars of assets decides that they want better service or they don't trust the exchange, now you have a market dynamic. And that works because there's huge amounts of assets at risk. And there's armies of lawyers and armies of accountants. It's like, you have to go through a Sarbanes-Oxley, risk control audit in order for me to do business with you. And that means we've got a list of 10,000 things. So I think that the institutional players, the SEC 40 trust companies and the SEC 33 Act operating companies, those are applying pressure to the crypto exchanges to become much better. But they're also the ones that are lobbying for the repeal of SAB 121, right? And the repeal of SAB 121 will result in all of the major banks in the United States and then the rest of the world starting to consider becoming crypto custodians and Bitcoin custodians and the like. And so that's going to happen because BlackRock and Fidelity, and other megacorps talk to their senator, talk to their congressperson, talk to the regulators and point out that they want more options, and the banking lobby gets involved, et cetera. And so Bitcoin is going through this seasoning process where really it's encouraging new companies to buy it, and it's encouraging new custodians to custody it. And we should welcome both, right? The more corporations that own it, the better we are. And the more corporations that custody it, the better we are.
It strikes me as, if there's any risk in crossing the chasm for Bitcoin, getting to the mainstream necessitates infrastructure where the 12-year-old and the 85-year-old don't have to do self-custody. And so, I think that's what we've been working on, trying to improve the options there and improve the format of what's possible. Because when when you have this digital value, you dematerialize value, you have the ability to reduce the friction so much in the custody options, custody formats, and the competition. I think that you articulated so well there. I guess a two-part question here of Michael, do you think there are risks in crossing the chasm for Bitcoin, or do you think that Bitcoin's endogenous properties make it so that it will not have a problem continuing into the mainstream?
I don't view them as risk as much as just it's like asking me in 1650, are there risks in building Manhattan into a great city in North America? There's steps that have to be, if I find you the greatest port in North America, an island of granite sitting between the East River, the Hudson River, with the great natural harbor, right, in the right location, and everybody's decided it's their favorite city, and the year is 1650, are there risks with growing the city? I mean, I suppose, but I don't think of it that way, right? I just think there's challenges to be overcome and opportunities, right?
Yeah.
And so I think Bitcoin's going through all that, right? There's stuff to be built.
Yeah.
Right. If the accounting changes for every company in the world in February or January of 2025, then I guess that means the accounting profession has to learn a bunch of new things. There's new stuff to be done, right? New procedures and accounting systems to be, reviewed. And likewise, it's one thing to say banks should custody Bitcoin. It's another thing to create, are 10,000 banks going to create their own Bitcoin custody service? Well, is that a risk or is that an opportunity? I guess I'm back to 1900 and I'm in New York, and we just invented electricity. And I'm just pointing out that I think like one day all buildings will be wired with electricity. And you're asking me, are there risks in the wiring of New York City with electricity? And I guess there's going to be some electric fires, right? And there's also going to be a lot of fire insurance to get sold. And there's also going to be electricians, and there's going to be electricians union, and there's going to be a lot of projects, and there's probably going to be a bond, and somebody's going to complain about it. We're going to dig a lot of trenches, right? Because where are those power lines running? And someone's probably going to put a drill, jackhammer through one of the power lines, and stuff's going to happen. And then we're going to fight over whether we burn coal or we run the power line to Niagara Falls. And there's going to be stuff, but I just think there's just a lot of work to be done. We're building out the future.
One thing that's nice too about Bitcoin as compared to Manhattan is with a city, you might have a single regulator or jurisdiction that you got to deal with. And of course, you got to negotiate to rights of way to build out the infrastructure. Nice thing about Bitcoin being that it's global and open. Anybody can build on anything. As you say, a bunch of banks can give it their best shot, and there'll be competition among them to provide the best service, and the market will decide. Are there any areas within Bitcoin infrastructure? You mentioned custody, you mentioned banks. Obviously, you've got corporate adoption. Are there other areas that are particularly fruitful or interesting with respect to the story right now that you're watching carefully, or are those the main ones?
Well, I'm focused upon Bitcoin is digital capital. So it's the transformation of financial and physical capital to digital capital. And that's not complicated. That's a very simple idea if you just say it like that. But the implication is it's also driving the digital transformation of the capital markets. So the capital markets are fragmented, right? The bond market trades in Japan at different times than the bonds trading in Germany, and then the bonds trading in Brazil, then the bonds trading in the US. and the equity market, right? Our existing capital markets are built around equity and debt, and there's some derivatives, right? Equity, debt, and derivatives, and they trade 9:30 to 4 Monday through Friday, and they don't trade on the weekends, and they don't trade on holidays, and they're all fragmented, and they're limited in access. So the implication of somebody being able to trade in a capital market in Australia on Saturday and having an impact somewhere in the United States, 12 hours off on the time zone or something. That's interesting. So a real-time 24/7 global capital market is interesting. And up until now, it has been, again, it was 0.01% of the money in the world, when it was 6,000 or 7,000 a coin. And now it's 0.1% of the money in the world. And so it is a global digital capital market, but it's still de minimis in amount of capital. And so I think that as you see bigger players come into the marketplace and it gets to be 1% of the capital of the world, now you're going to have the tension of the 20th century. The 20th century capital markets, they're fragile. They're limited to a certain set of people. There are very limited settlement options. They're slow. They're not smart. You can't trade Apple stock 100,000 times on a Saturday afternoon, right? You can't vibrate it at a high frequency. You don't have you can't self-custody. You can't program it, right? So the capital that's in the traditional markets, it's not programmable. It's slow. It's fragile. And the capital in the 21st century, it's going to be smarter, faster, stronger. And so the interesting opportunity is what happens when the investment bankers and the commercial bankers and the money managers realize that digital capital is smarter, faster, stronger, universal, right? Because it has a lot of implications, right? Like there's 50,000 publicly traded companies, and how many of them are capitalized on Bitcoin? How many of them are capitalized on bonds? So 99.99% of the corporate capital is financial capital, which is fragile, fragmented, right? And defective, right? Digital capital is appreciating at 45% a year, and over the last 4 years, and financial capital is depreciating at 4% a year.
Yep.
In fiat, this is in USD terms, right? But I think that has profound impact on investment banking, right? Like, why wouldn't you go and recapitalize every company? So that's interesting. I think what's also interesting is it's like the same the financial world brags about taking settlement from T plus 5 days. Like in 1970 to 75, it was like T plus 5 days, T plus 5 to 10 days, then T plus 3 days. And it was T plus 2 days as of a year ago. And now we're getting to T plus 1 day. But we're not T plus 1 day. On Friday, it might be from Friday at 4 till Monday at 10 a.m. or something to settle something. So money still moves very slowly, and it has to pass this fragile network of correspondent banks, and anybody can block the move. And you can't program it, right? So I use this phrase, when you think about digital capital is invisible, right? It's intangible. It's immortal, right? It's indestructible. But while you're working through your bulls, like comparing it to a building, it's all those things. It's musical. And the musical is something to think about, right? Think about a symphony. Think about vibrating the strings of a guitar. You know, think about, energy, frequency, and vibration. And think about Mozart's or Beethoven's Seventh Symphony or Beethoven's Ninth Symphony. Think about what happens when you start to vibrate on various frequencies, and literally you hear it and it's beautiful. And then think about how fast you can vibrate a building. And think about how fast you can vibrate a $1 billion block of Apple stock.
Check out the link below if you buy and spend coins. Check Nexo Exchange $35 in Bitcoin just for sign in, and I'll see you in the next one.